you very much, everyone, for joining our webinar. It's a pleasure to have you all. I see a lot of attendance. My colleague Victor is going to introduce we have a very interesting panel today. We're going to be talking about options and intervention and the real and the Colombian peso and the Mexican peso and a bunch of other very interesting things to try to do something very academic about thinking about the experiences of other countries with the options scheme for intervening the currency at levels of extreme volatility or much higher levels of volatility than we are normally used to. So thank you very much on behalf of XP Investimentos and XP Investments here in the US. It's a pleasure to have you all here. We're going to have a very nice conversation. And let me pass the word to my colleague, Victor. Victor is going to be introducing the initial part of the panel, and then we go into the experiences of other countries in the region. And that way we have a very nice conversation on this specific issue. Thank you, everyone. Victor, please.
Thank you, Bruno. It's a pleasure to have a very senior team today here with us. We have the pleasure to have Marcos Molica, which is a PM in the Opportunity. He holds a PhD in economics from the University of Chicago, and he's been very vocal on this matter in the past few days. And it's very good to have him here. And to also discuss the matter, we have Felipe Guerra, which is the founder and CIO of Legacy Capital. He's a former treasury director of Santander in Brazil, and he has a very successful fund as well. And we have also with us Daniel Saraiva from our options desk, who is actually going to start today and give a brief overview for those who don't know exactly what would an intervention like this work like. And he'll give us a brief overview, and then we'll go to Marcos Molica. He has a very short presentation, and then to Felipe Guerra. And as Bernal said, then the Central Bank of Colombia is going to share their experience with us. And then we can go to Q&A and have a very healthy and very good discussion. Thank you all for joining. Daniel, the floor is yours.
And actually, Victor, let me talk a little bit before Daniel, because I think it makes more sense from the way that this will flow. We have with us Pamela Cardozo. She's a PhD. She holds a PhD from economics from Queen's University, Kingston-Canada, and she's being the head of the Monetary and International Investments department at the Banco de la República and this Colombian Central Bank since October of 2010. And we also have with us Juan Sebastian Rojas, who is an industrial engineering with a minor in finance and economics from the University of Los Andes in Colombia. And after 5 years in the reserves management department of the Central Bank, where he worked as a risk management and research areas, he moved to the US to complete his postgraduate studies. So we have, as Victor said, very senior members of the Central Bank with us. We thank you, both of you, Pamela, Juan Sebastian, for joining us as well. And with that, Daniel, please go ahead, and then we continue with the webinar. Thank you very much.
Thank you all, guys. Good evening, and thank you everybody for joining us on this important webinar. And I hope all is well and with you and your families. And the idea behind this webinar, in my opinion, is to try to relate the experience from Banco of República in Colombia, try to relate with our own experience and our own situation nowadays, where we are facing like a huge volatility and that could be dysfunctional to the market. So as a small brief, the Colombia started using options as a way to build up reserves, and at some point they changed it. They used their experience by doing that to try to curb volatility on the market as well. So it will be a huge opportunity for us to learn from their experience, since the literature about it's very scarce on the internet. And actually the best one that I could find is from Pamela, who is here with us. And the central banks that actually intervene into the market through options, they are very scarce as well. I hope you all enjoy this opportunity as I'm enjoying already. Thank you, guys.
So Marcos, feel free to start, please. Thank you.
Okay. First of all, thank you very much for the opportunity. It was very nice to have so many experienced and senior people talking about this subject. I think it's a nice opportunity. Can you guys see my presentation?
Yes.
Okay,
Yes.
let's start here. Well, talk about the central bank intervention. I think it's very clear that the mandate of the central bank is to target inflation and use the only instrument that he has, which is the interest rate. Exchange rate is floating, so in principle, the central bank has no instruments or no mandate to change the price of the exchange rate. I think central bank has a framework which is to intervene in the market when he notes some malfunctioning or some liquidity problem. I start saying that there is no question about this principle. We can diverge a little bit about when this is happening, but the general principle, I think it's undebatable. The idea of that I want to discuss here is a way to make this intervention more adequate to the market circumstance. The motivation here is that if you look at the behavior of the BRL in the last few months since the start of the crisis, you see, and even before that, I think, you see that the volatility of the exchange rate has become very, very high historically when compared with the peers. If you look at some graphs here, we put some just to highlight this idea. Here we try to estimate like the volatility using historical data, fitting a gauge and smooth with a moving average. You see that the BRL volatility is running in the last few months much higher than the usual peers here. I just put here the high betas, let's say, currency in emerging market space. And you see that atypically the BRL it's running with a volatility much higher than its peers. When you look in a broader panel of currencies, when I plot here in the x-axis here, the implied volatility, 1 month implied volatility, and in the x-axis here, the return of the BRL in the last month, you see that not only the BRL performed badly in the last month, but also the volatility is stick much higher than the most of the peers, or is the highest volatility here in this panel. So this is motivating the discussion. We try to fit some model here to understand what's happening. What we did here is to fit a quite general model here to the smiles. This model here, I don't want to enter in detail here, but it's just is a general enough model that allows for jumps in the effects and also for stochastic volatility and the correlation between the smile and the level of the curves. When we did this in the beginning of the month, we fit the model in the beginning of last month, and we shocked this model with the size of the movement in the real in the first week. Just an example, with the size of the movement in the currency in the first week of the last month, which was a big movement in the currency. I think around 5% of movement in just a few days. And you see that the smile of the BRL moved much above the red line. You see that it's much above what the model has predicted. When you do the same exercise for a very high beta currency like the ZAR, you see that in fact the movement in the smile was lower than the model was predicted, the same model. So you see that the response of the BRL to the negative shock, it's become much higher than other peers. And this is, I gave here just an example. You can use other windows here to show the same point. In my opinion, here in Brazil, this is not happening because there is an structural bet against the BRL. I think in this uncertain environment, I think markets are looking for hedges, hedges for higher moments in the distribution of the returns. You see that there is no structural reason for the real to be depreciated at this speed or this size. Here I have a chart with the balance of payment gap. And you see that it has been, in fact, been improving. This is happening, it's trivial process. There is an improvement in current accounts because of the recession and the devaluation of the currency, and is more than compensating the deterioration in the capital account. And this is in the last few months, you see this V shape in the balance of payment. And if you project this a few months or for next year, you see that the balance of payment is already indicating some small surplus of reserves. And then you don't see any structural gap in Brazil. So I think this is an indication that there is some behavior here is kind of the market looking for a good hedge for other bullish positions that they have in the portfolio. And why it's BRL is being used, I think I can list here a few motivation, like you have a decreasing carry cost in the process of cutting interest rate. I think the interest rate differential with Brazil has decreasing a lot. There is no pressure for appreciation. As you see here, the balance of payment is almost zero. And I think this is important, the market depth. Brazilian is a very liquid market in emerging market space. I think this is an important reason. And then you ask why this increasing volatility is so bad. I think it's the case here is that it increases the risk of investment in local currency in Brazil. So I think it scares some flows that could be coming to Brazil to direct investment, investment in equities. People who put money in Brazil has to put the interest rate, the exchange rate risk into account, and this make the investment, this volatility make it the investment much more risky. And also because of that, of course, it's gonna ask for premium. And then I move to the intervention. The idea it's just at a start of an idea that we want to look at the opinion of Central Bank of Colombia that has a lot of experience with this, and also the experience of Guerra that understands a lot of the option market. But in my view, the intervention using options, I think would complement the central bank arsenal in the interventions. In this environment, what I'm proposing here is that markets who know for people who knows the more technical language is not complete. You have jumps, you have volatility risk. In this environment, risk aversion here plays some role in the price of the derivative. And we are living in a moment of very high uncertainty, and this will make the risk of people very risk averse to offer this insurance to the market. At the same time, usually in the past, I think people who is in the market for a long time knows, I think banks would be a natural provider of this insurance. But since the last crisis, the mortgage crisis in 2008, I think the regulatory changes make much more strict conditions for the bank to carry risk positions. I think the ability to the banks of carrying short gamma position has decreased a lot. So I think you have here a case for some insurance provider of last resort, let's call it like this way. In my view, the central bank is it's very well positioned to do that. It holds a large amount of reserves, and it don't have these regulatory restrictions and can carry these positions of short gamma for a long time. And there is no restriction for them to put that in the book. In practice, the central bank is sort of completing these markets. There is offering some contingent claim to the markets. Some is provide insurance that the markets itself cannot provide at this moment. I think this, to conclude, I think this will be efficient for the FX market. I think the agents will have more instruments to manage the FX risk. The central bank, of course, will collect a premium for provide this insurance. And of course, if the option is exercised in extreme conditions, the central bank will sell the spot in the levels that probably he would be selling anyway with the usual the conventional spot or swap interventions. So I think the spirit here is to give an idea for the central bank to complement its arsenal. It's not, I want to stress that it's not, I'm not suggesting that the central bank should try to change the course of the currency. It's just that this, there is indication there is some anomaly in the market, the volatility is too high. And I think there is a place for the central bank to provide some insurance in the market. I think now I would like to hear you guys, what do you think? And then we come back to Q&A.
Yeah, please.
Okay. Thank you, Vitor. Thank you, Monica. It's a pleasure to talk to you guys here. Thanks for the invitation. It's a very strong panel. I think it will be a pleasure to exchange ideas here. I appreciate Monica's presentation. I think there are very good points. He showed that Brazil has been faced in the FX space very above average volatility in FX. When you look at the implied volatility, if you take a moving average for the implied volatility, it has been at the highest since a long time ago, like 2014. And it has been holding at this level for a long period of time. In the past, we were used to have these shocks, and then in 1, 2, 3 months, we get rid of the volatility, but it's not the case at this moment. When you look at the implied volatility, it has the same shape. The moving average is at the highs as well. So that's a reality that we have to live with when we are facing the markets. The volatility is really huge here. It's trading above the stocks volatility in Brazil. I think it's important to, as Monica said there, it's important to understand the cause and consequence of this above average volatility. I think the consequences are very clear. It has an important cost to the economy in the sense that for an importer and exporter to price transaction, they have to use a very wide spread. If you are an importer, you have to put the currency close to 6. If you are an exporter, you have to price very close to 5 or below 5 because the volatility is so high that you have to deliver a product or buy some stuff, buy some machine in a few weeks, and that can change so much that you can have a very huge transaction cost. Actually, it hurts more the small companies and small economic agents. I think the bigger ones are able to have pricing power and pass this cost to the chain. But it's a really a Brazilian cost for players that want to play in Brazil, locals or offshore players. Also, as Molika said, if you are a foreign investor and you see this huge volatility where nobody knows and could explain where the value of the currency is and where it will end, people wait in order to see where it could stabilize in order to make a long-term investment. So I think foreign investors will wait for have more clear where the real currency value is. So that's the consequence of this huge volatility. I did not see the central bank recognizing it at this moment. Yesterday we have a long explanation from the Roberto Campos, the president of the Central Bank of Brazil. He's still on the camp that the currency is floating. We are passing through adjustment of the economic price in our economy. We have lower rates and a devalued currency. So I don't think central bank has recognized that yet that this volatility is a problem. As soon as they recognize and start to act through options or through swaps, they will be able to contain because they are the biggest player in the market. So they will, whenever they want to act and contain this volatility, they would be able. Maybe they doesn't need to use options, maybe verbal intervention and selling some dollars through swaps and then repurchasing at the end of the month, not doing the rollover. They can contain the volatility. And if they act 1, 2, 3 times, then the market will recognize that you are playing against a big player and we will respect and probably you have a smaller volatility. But it's not a problem that the central bank has recognized yet. I think there's we have contact with many people from the economic side, clients and friends. Who I listen a lot of complaint. Even talk to market participants. The complaints are also huge. Most part of the people are not understanding what's going on in Brazil. When we look to the fundamentals, you look to the CDS, commodity price, interest rate in Brazil, and the differential between here and outside, we see that the currency would be more close or a little bit below 5. When you look to the peers, probably it can be a little bit stronger than that, more between 4.75, 4.85. So there is a premium in the market at this moment, but there is also a big uncertainty in the external markets, in some sense, also in the local markets. And I think one of there are some reasons. I talked about the consequence. And now I will try to elaborate a little bit about the reason why we have this huge volatility. I think the first one, as Molika said very well, is the interest rate. I think the cost to bet against the currency is so low that whenever we have any problem anywhere, it's good to short BRL. And whenever you are not scared anymore about this subject, you unwind this position. So that's why if you have any problem today, you have Bolsonaro with COVID, you short dollar BRL. Tomorrow, he's getting better, you unwind the position. So there is a problem with Trump, you short BRL. In China as well. So this very low interest rate has good consequence for the country, but has also bring this bad consequences that this huge volatility here. So I think that's that's something that if is not addressed by central bank, we will be obliged to live with for along the road for a while. Besides that, I would say that the economy faced 2 important points of outflows. At the first stage, we saw some local corporate deleverage in a huge size. Petrobras was one of the biggest corporate that bought lots of dollar, especially in the beginning of last year. And it brought to the market some disequilibrium. The market was clear, it was clear that there was we were not in an equilibrium anywhere we were facing this more demand for dollar than supplies, especially last year. And then at this year we have a special flow, local bank outflow related to the hedge in the offshore banks of the local banks. They have to unwind and decrease these transactions. The consequence was a big outflow, especially in the derivative markets in Brazil. And also, again, we are not in equilibrium anymore. Central banks have sold some dollars, try to get some equilibrium, but I still think that the market seems it's a kind of a short dollar in a size that makes this volatility to get healed. So it's a combination of some punctual outflows from the economic side, low interest rates. So that's I think is the main cause of this huge volatility. But at the end, it takes some time for the central bank to recognize that it's a problem. If they don't recognize, we will have to live with that for a while. I agree with Molika that using options is a good way in order to act. I'm curious to listen to the Colombia friends about the experience that they have there. I see many ways that the central bank can use the options in order to act. I was discussing that with Molika some days ago. Probably if they have some a kind of a problem in relation to regulation, talk to the regulators that they are selling volatility or something like that. Probably they can register the transactions as a swap with limits. So there is a optionality input embedded in this swap. It's a way to do this. As you know, the central bank does like SCS here in Brazil. SCC is the instruments that they use in order to act, to sell dollars or buy dollars in Brazil. They can do the same instrument that they have been doing, but adding a limit that would mean that there is an option embedded on the transaction. So that's the way they can sell volatility, use the same instrument that they have right now. Not saying to regulators or the lawyers that they are doing something very special, very different. So at the end is a swap that has a payoff above a certain limit, like the payoffs that we face when do our options. So that's the way we transact with some corporates here in Brazil. When I was working for the bank, you don't have some when I registered some corporate optionality. We did like this swap with limits to register that CETIP. That's a local exchange here in Brazil. We were used to do that. Of course, central bank knows that. Roberto was also used to do that at the bank. Knows very well this way to do this kind of instrument. So that's an option. But I would say that first, if they have to communicate to the market that they see a problem. That's the first step. The second step, they do like a verbal intervention. The third one, they try to use the swaps that they have right now, and they can sell and purchase at the end of the month. So they will decrease the volatility. And then they have the optionality in order to contain this huge movements that we are facing. A last point that I want to add in order to is a kind of a curiosity that I have. I was trying to investigate what's going on in the market. It's very curious that the volume that the PA accounts have been trading, BMF, has been twice the volume that we have been trading in the dollar, the bigger dollar contract that we are used to trade in the institutional markets, banks and funds and for investors. So the volumes in the mini dollar, the smaller contract, that was nothing in the past. Nowadays, it's twice the volume that we see on the bigger contracts. That's a kind of I would finish what I'm saying weird. It looks like we are in the middle of a casino, make some bets. So a lot of people that were not used to trade dollars are getting involved, doing heads, using the dollar in order to buy more equities or trying to make intraday movements. It's big volumes, really big. It makes a difference. It makes a difference. It increases the size of the movement that we face every day. Today, we opened the market. The dollar was 5 cents above yesterday close, and then in like 2 hours, the dollar was like 10 cents below the opening, and in 2 hours more, we were like 15 cents above where we were in the middle of the morning. So is amazing. It's a kind of a casino. What I did from my perspective here, I took the dollar out of my screen at Bloomberg, because I think it's if you get involved in the dollar, if you do a hedge, you can lose. I can see you losing like 40 cents in a week and make 40 cents in a week. So a hedge that you don't know what would happen in the short term, and the volatility is so huge that I don't think it's a hedge. It could create a big make your payoff very bad, in the trade that you have higher conviction. So you have a higher conviction rates on equities, and use the dollar to do a pair trade, and then you have no clue where the dollar would be in half an hour. So it's I prefer to not be involved at this moment. In a medium term perspective, I would say that the country is facing like a financial repression, have very low rates. People will want to have more external assets in their portfolio. So whenever you have a huge appreciation of the currency, PA accounts will want to have more external assets, so they would buy dollar. But I don't think it would happen, this huge volatility at these levels at this moment. So I strongly recommend not to do anything in the dollar in the short term, because the volatility it's amazing. That's it.
Thank you, Felipe. Well, once again, thank you, Marcus. Thank you, Felipe. Thank you, Danny. Now we have the great news that we have an experience that we can relate to, because what you guys are talking about, Marcus and Felipe, I remember many years ago when before the Central Bank of Colombia started doing these interventions, we were wondering about the same issues because of the negative side effects of extreme volatility in terms of everything around the economy, in terms of price generation, in terms of, as Marco was saying, if you're an exporter, you do this thing. If you're an importer, you do this other thing. Whenever your currency moves too much, and that's obviously not efficient from an economic standpoint. So the good news is that we have Pamela and Juan Sebastian, who are basically two of the persons that have been behind this options mechanism in Colombia for a very long time, and that way we can hear their experience of how the thinking went inside the central bank as to how to get to this point of going this way and allowing for that. From my standpoint, Pamela, before I give you the word, and Juan Sebastian as well, perhaps it would be great if Pamela, you give us a few minutes, and then Juan Sebastian, you mention and you add to the comments. But one thing that I would say from my experience, one of the things that I felt when I saw the decision from the Central Bank of Colombia to do this is that the first thing that came to my mind is like, okay, this is a very clean way of doing this, because you're basically not telling the market where you're gonna go in or when you're gonna go out. That's the beauty of it. The market knows you're eventually coming in, but the market doesn't know exactly when that is, because the strike is a function of the market itself. So you cannot manipulate that, and therefore it takes away a lot of the expectations building that traders do on a daily basis, and that way it allows for intervention to be much more clean, which is the word that I love. I like to use in this case. But please, once again, Pamela, Juan Sebastian, thank you for joining us. The floor is yours.
Okay, so thank you very much for the invitation. I'm gonna tell you the experience of Colombia with those volatility options since Colombia implemented them. So it all started in 2000 when Colombia changed from a crowding peg to a flexible exchange rate regime. So Colombia was very committed with the flexible exchange rate regime. The central bank didn't want to intervene. It just wanted to intervene when needed to accumulate reserves, or under extreme movements of the exchange rate. And because the central bank was very committed with the flexible exchange rate, the mechanism chosen was a rule-based mechanism. And those are the volatility options. And when the central bank implemented, it implemented both the put options and call options. So the market knew that the central bank was going to intervene, either selling or buying reserves. When the exchange rate depreciated a lot, it will sell reserves, or when the exchange rate appreciated a lot, it will buy reserves. So the mechanism was regulated. It was announced. The rules were announced. So the regulation of the central bank said the central bank is going to sell call options when the exchange rate moves a certain threshold above its trend. And the trend is defined as 20-day working days. And the threshold at the beginning, it was defined at 5%. And the opposite for put options. So when the exchange rate is below the trend, minus 5%, the central bank announced that it was going to sell put options. The quantity of the options was also announced. It was defined as an important amount compared to the market size at that time. So it was around 50% of the market size at that time. And the amount was $180 million. So that mechanism was put in place. It was in place for 3 years and it didn't activate it. I think it activated in 2003. Colombia experienced a depreciation because at that time was the Lula crisis in Brazil, and that affected Colombia. So we had a depreciation trend, and therefore the call options activated. Then I think we had an appreciation trend and the put options activated. And then the central bank continued with the mechanism, but it wanted to be more active in the market. So it started playing with that threshold. And it moved the threshold from 5 to 4%. And at some point it was 2%, which is a very narrow threshold. And the central bank at some point was selling and buying in a very short time of period. The idea with that mechanism was to provide a hedge to the market, because the derivatives market at that moment in Colombia was almost non-existent. So the central bank wanted to provide the mechanism to the market, and a mechanism that was announced so that the market knew that the central bank was going to sell or buy under extreme circumstances. At some point, the central bank suspended the mechanism, and we used it again in 2015 because the peso was under an important depreciation trend given the collapse in the oil price, and that was affecting inflation expectations. So at that time, the central bank said, I want to provide the hedge not more to affect inflation expectations. So to tell the people that don't worry too much about the trend, the depreciation trend, because if it is too steep, the central bank is going to intervene. So the objective at that time was to provide that hedge in order to correct inflation expectations. At that time, we started with a higher threshold. It was 7%, and we changed that amount because the 180% that I told you, because the market grew through the years. So at that time we said, okay, we are going to sell $500 million. The problem at that time was the threshold was very high, the peso continue with the depreciation trend, but if the currency continues with a trend, it is never going to activate. So the central bank was worried that the mechanism was not activating, and therefore, again, it started playing with the threshold. So it reduced the threshold from 5% and then to 3%. And then we had an appreciation trend, and the mechanism was in place. So the central bank had to sell reserves when actually the feeling was that the market was not needing those reserves. So the central bank did the auction, the market exercised half of the options, and then the central bank decided to quit with that mechanism. So, and the other thing is that in 2016, we only activate the call options. So volatility, call options volatility. We didn't activate the put options because, as I mentioned, the peso was under a depreciation trend. So what we have learned with this mechanism is that, yes, it is useful to provide a hedge to the market when the market needs the mechanism. It is not useful to control actually volatility. I think that's like a wrong name for those options because the central bank, so I think the idea of the name is that it is like a crawling band. So if the crawling band is credible, then the exchange rate is never going to get out of the crawling band. But the point is that, crawling bands are not credible. So a mechanism that has thresholds is less credible because the central bank it doesn't have all the power to intervene because it doesn't even have all the power with a crawling band. So at the end, these options are not good to control volatility. I think they are useful to provide a hedge, but other than that, that's not the objective. And there has been some research at the Central Bank of Colombia in terms of the effect of different types of intervention in volatility and also on the level of the exchange rate. And most of the literature says that sterilized intervention is not effective in controlling volatility or the level of the exchange rate. So again, I think just to conclude, this is a good mechanism to provide a hedge to the market when needed. But its effectiveness in terms of the other types of intervention, I think has the same level, the same level of affecting volatility and the level of the exchange rate. I don't know if Sebastian wants to add anything else.
Yes, please, Juan Sebastian.
Okay, good afternoon to everyone. Thank you for having us in this conversation. I think that Pamela already covered most of probably the motivation and in general terms the dynamics or the way that we implemented the mechanism of the central bank. Probably I would like to reinforce a couple of points that I think that are very important. In the first part of her explanation, she mentioned that basically this was a mechanism that was created not to contain actually a strong depreciation or a strong appreciation, but rather was a way to probably smoothen the trend of the exchange rate. Because actually, another concept that is very important to point out here is that in Colombia, we like in some way the volatility because at some point, the exchange rate works as a buffer for external shocks. So those movements can basically respond to the reality of the world, of the economic world. And in some sense, that kind of volatility can discourage actually local actors from taking a lot of risk in those episodes where probably the economy is more stable. So they don't have to face those kind of extreme scenarios where they can face actually a lot of losses just because those movements in the exchange rate. So actually, I think that the volatility is something that is healthy for the market. However, we don't want to have those really extreme movements that actually are not reflecting the fundamentals of the economy. So those are basically the scenarios where we want to be part of the market by putting this kind of hedging instruments, as Pamela mentioned, so we can provide some kind of an insurance for the market that we don't want, or we are not going to let the exchange rate go to those very extreme positions that are not reflecting actually, once again, the fundamentals of our economy. That's another important point that I want to provide. I don't know, something that is very important also to mention here is that most of our interventions were pre-announced. So basically we announced both the amount and the durations probably of the programs. We have also at the central bank the right to, when all the options, for example, were exercised, probably we have the right also to start with new options if we consider it is needed. So this is something related to one of the questions that I can see here in the chat. So basically we start with a predefined amount. However, the Banco always has this attribution of providing probably more hedging to the market if we consider that it is needed. That's something that I wanted to point out as well. I think that we already cover in like the general aspects of the mechanism. So I don't know if you want to start probably with some general questions that we can help you with.
Sure. Thank you, Juan Sebastian. Thank you, Pamela. Well, now we're gonna go into the Q&A section. I'm gonna ask my colleague Victor to help me with that. He's much better with technology than I am. But one question that I wanted to ask to Pamela and Juan Sebastian is in terms of if you guys observed that the options mechanism had a positive effect in terms of total volume of the FX market in Colombia, meaning that the trading floors of the banks became more comfortable trading the currency. Basically, if this was welfare enhancing from the standpoint of increasing the volume of Colombia's of the copy market in Colombia, or whether or not, or whether there from your studies and from your perspective, there wasn't really much of a positive push from this innovation.
Sebastian, you want to answer that question? Because we haven't studied that much, but Sebastian recently is working on that. So I don't know if Sebastian, if you want to answer the question.
We actually, it's just, the point is that we haven't seen a particular movement in terms of a reduction, for example, of the volume that's been traded in the market at the point where we started basically participating in the market. So basically the liquidity in the market, we haven't seen a very dramatic change in terms of the liquidity. So we cannot say that basically by being in the market, intervening with the options, created an important difference in terms of a correction, if you will, in the liquidity in the market. Recently, that we observed this current juncture, an important decrease in terms of liquidity. I would say that the participation of the central bank, but this is something different. This is a different mechanism. Probably could have helped to normalize in some way the behavior of the market. However, I think that is not, it wouldn't be completely true just to say that by being in the market, we would increase the liquidity of the foreign exchange market. Probably, as Pamela mentioned before, in some literature that we have followed with respect to the effectiveness of our interventions, it seems that, or there is some evidence that shows that we have been effective on controlling or affecting the volatility a little bit in the market. However, there, as I said, probably there is not enough information, or probably there are contradictory results in that matter. But with certain measures, I would say that we have been very effective, probably on giving the market with the assurance that we'll be there in those episodes where it is important to have some support to the market.
Great.
Yes, and I will add, now I remember that in 2016, the other reason why we decided to use, to intervene, was because we were seeing low liquidity in the market. And the other reason was the expectations of inflation, as I mentioned. So at that time, I think the announcement that the central bank was going to intervene under an extreme depreciation, it helped a little bit in terms of the liquidity of the market. But I think if you really want to, if a central bank really wants to help in liquidity, I think a better way to be, a better mechanism will be to intervene in the market, either through derivatives, like forwards, or through or selling reserves directly. I think that will help more in terms of liquidity than a mechanism that is only going to activate under an extreme circumstances.
I have a question. I wrote a question and I see some questions in the chat that look like it. I'll actually ask to Guerra and Molika and to Daniel Saraiva, my colleague here. Here in Brazil, the central bank has used swaps, credit lines, spot auction, all other tools on the toolbox we know. Is there any other way you can think of that the central bank could intervene to reduce this volatility problem? And I add here, if they do something to curb the volatility on the FX, is there any other way that this volatility that is there that would show up in another asset price or somewhere else? Is that a risk that you see? I don't know, maybe Marcos, you can start, and then yeah, and Saraiva, please, if you can comment. Right, you're in mood, Marcos. Oh. There you go.
So let me understand. You asked if this volatility real is translating the volatility of other assets as well, or if the central bank use other instruments to control the volatility, right?
Yeah.
Well, the suggestion here is to complement the arsenal in the hands of the central bank. I think my interpretation of the market at this moment is that the market is in a very uncertain moment. I think there is a big difference from Colombia. The market here is very deep in terms of liquidity, so it can provide hedges for, I think, a large class of assets in emerging market space, or even in other portfolios. So people can buy, came here and buy dollar real to protect against long positions in other emerging markets. I think that's an additional problem of the real. In this moment in particular, I see that the market is not clear. The market is in a clear bet against the direction of the real. I think, as I showed in the presentation, the balance of payment, it's okay. The fundamentals in the margin, it's improving. So I think it's more a case that the market's searching for some kind of insurance. In the market talking, we say that the market is want to buy some convexity, want to have some hedges for like the fat tails of the distribution. I think that's the mind of the market in the moment. I don't think if you talk with people in the market, you don't see a clear, as Guerra was saying, I don't have a clear direction of the BRL at this moment. Nobody, a lot of people that you talk, it's the same thing, but the volatility is very high. So I think the market is looking desperate to have some hedges for a more clear bull position. For example, long the stock exchange and long the dollar BRL, for example. In this environment, I think providing insurance through options is more efficient than doing this through swaps. I think, of course, if they sell spot a lot, if they use swaps, you have the same effect. We are just here to talk about the efficiency of the mix in the instruments. If they sell spots a lot, it will control the effects as well. So it's just a suggestion for the central bank to improve the efficiency of the market. And here in the FX space, in the option space, in my head, is the same framework that we have when we intervene in the spot. We don't want to change the course of the currency, not even suppress volatility in the market. I think we want to just to intervene in the stream behaviors where the market's not functioning well, and for some reason the central bank can complete the market. That's my view. It be a mistake as is the mistake to intervene in the spot market or the swap to change the course of the currency. In the volatility space, it's also a mistake to try to suppress volatility in the market. It's not that the suggestion. It's just to act in the same spirit and act in the extreme case where the market is not functioning well. Has some thoughts on that.
Okay. No, I fully agree with your thoughts, but what I would say that at the first point we need the central bank and the government in order to recognize that there is a problem. If they don't recognize that there is a problem and they keep on the speech that the currency could be anywhere and it's just a relative price adjustment on the economy, they, in a sense, they incentivize people from abroad and for local market to hedge and use the BRL as a tool to protect the tail risks in their portfolio. Up to now, I don't see any change on the speech of the government. If you heard Joe Paulo Guedes and Roberto in the last two interviews that they gave, they seem very comfortable with the valuation of the currency. So as they are comfortable with the valuation of the currency, they are open space for the currency to develop more and more. We are still discussing Brazil, spend hours and hours with the economists and friends and colleagues discussing if Brazil should cut 25 basis points more our Selic rate or not. We are on a clear economic acceleration path at this moment, and we are still discussing if we need to cut 25 basis points more on the Selic rate. So I think the discussion from the economics and the speech of the government, they support this hedge flows on the BRL. So that's if you keep on this discussion, keep on this posture, I think BRL will keep on being an alternative to hedge the global portfolio and local portfolio going ahead. So I think the first stage again is to recognize that this volatility can damage the economy, can make the spread to transaction make transaction in Brazil much wider, and cost a lot for the economic agents in order to act in Brazil. Of course, we agree that central bank should not act on the level or change the dynamics or the level of the currency and the trends. They will keep on acting in order to contain the volatility, the big movements going ahead. But again, if the speech is the same, the posture is the same as it looks like, I would bet that the volatility will keep at these higher levels. And when they recognize the problem, they start to make it first in verbal intervention and then use swaps or spot or credit lines or options. And then the market will respect and will recognize that they are worried about the currency, they have big reserves, they succeed in the past when they acted. So I think that's the message here. But I fully agree with the arguments that Mollica brought to us, and then the intervention approach that our colleagues from Colombia put here. I don't see if you use your options. I'm not probably you won't change the trends of the currency if you have to devalue because our fundamentals are worsening. We probably will continue to devalue, and the other way around as well. So that's a point. But I think the important message here, I think first we need to move a step back and recognize, have the government recognize that that's a problem or not a problem. Up to now, I don't think they think it's a problem, so I don't think they would act, and probably the volatility will be at a higher level for the following week. So let's see how they would react to that.
Daniel, if you want to add, or
yeah, I fully agree with you too, guys, and I would just add that, yeah, of course, the central bank needs to be vocal. It's the first tool that he has on his portfolio to be vocal about it, and I'm not comfortable with this kind of volatility, and this kind of behavior can trigger some other behaviors among the participants. But I also believe that central bank needs to be cautious when we discuss intervention through options, because as you guys have said, the Brazilian market is a kind of channel for liquidity for the whole emerging market, right? So the future market in Brazil, it's like it's daily traded $60 billion, and when you take a look on the options market, it's less than 4. So I can imagine some tool built by the central bank to be applied on an options market that it's 4 to impact a broader market that is 60, right? So, but trying to keep the discussion related to what Victor asked, I would say that we could discuss a lot of instruments in order to curb volatility. For example, volatility swaps, variance swaps. I believe it's a good instrument that keep gamma constant in a way to provide this break to the market, because when you intervene through options, you kind of have a region around the strike that your gamma it's functional, right? So if the market moves away from the option, you're not gonna have the same efficiency of the previously intended intervention. So yes, I believe the experience from Colombia can be improved in our market, and I also agree that central banks should develop more tools. And if I may, I would like to take the opportunity to make another question to Pamela and Sebastian, which pretty much they answered, but I'm gonna ask anyway. Like now and then Brazil get back on the agenda of conversibility, right? And in the past, as you mentioned, Colombia abandoned the crawling bands to a managed floating profile, and now it's a broadly considered floating country, right? For the currency. So based on your past experience and considering that Brazil would pursue a free float classification on IMF, in order to be to become a convertible currency. What is your opinion about the implication of using volatility intervention through options on, for example, IMF perspective for this regime classification? Do you think it could jeopardize this major goal of ours?
Okay, so I don't think it will jeopardize your goal. It will help your goal if you get rid of all the other interventions. So for example, when Colombia moved from the crawling band to the flexible exchange rate regime, and the only mechanism of intervention used were those volatility options, and the others, that the put options to accumulate and the call options to decumulate, that the put options were used to accumulate reserves when needed, and the volatility option, was a mechanism that was always in place without regarding the level of the exchange rate, without regarding the volatility, and it was an announced mechanism. So at that time, from 2000 until 2003 or 4, the classification of Colombia was flexible exchange rate regime under the IMF. Then the central bank started playing with that, with those mechanisms. So it started playing with the threshold because the central bank was worried about the trend and the mechanism was not activating. So as I mentioned, the central bank started playing with the threshold. Then it was also using the put options to trying to affect the level of the exchange rate when not needing the accumulation of reserves. So that at that time, the IMF changed us from a flexible exchange rate regime under a managed flexible exchange rate regime. So that mechanism of volatility options, if you just use that one, and as Alberto mentioned, it's a very clear and transparent mechanism that you just want to intervene under extreme circumstances. So that will help providing a signal that you want a flexible exchange rate regime. But if you combine that mechanism with other types of intervention, then you will not be classified under a flexible exchange rate regime.
Great. Well, that was a great question, Danny. Thank you very much. We have to be very respectful of everybody's time. It's 7:09 already, so I'm going to close it down here. Felipe, muito obrigado. Great to see you. Pamela, that's a great presentation. I really appreciate your time. Juan Sebastian, it was great to see you. Marcos, thank you very much for all your views. Danny, Victor, great panel, and thank you very much. Stay safe. Hopefully we'll see each other not in a virtual manner, but in a real manner soon. So thank you very much for your time. I really appreciate it. On behalf of XP Investments, it's an honor to have you all. Thank you very much, and thank you for calling in.
Thank you very much.
Thank you.
Thank you.
Bye.
Bye.